Every day, millions of people scroll through social media, watch financial videos, and read online discussions about the stock market and cryptocurrency. Tips, predictions, and stories of people turning small investments into huge profits are everywhere. But behind much of this online financial content lies a powerful force: market psychology manipulation. The internet has made investing more accessible, but it has also made it easier than ever to influence how people think, feel, and invest their money. Market psychology refers to the emotions and behaviors that influence how people buy and sell assets. Feelings like fear, greed, excitement, and panic often drive financial decisions. In the past, these emotions were influenced mainly by financial news or economic reports. Today, social media platforms, online forums, and even comment sections can influence markets in real time. A single viral post or video can cause thousands of investors to rush into an asset within minutes, often before anyone has time to analyze the fundamentals. One of the most common psychological triggers used online is FOMO, the fear of missing out. You may see headlines like, "This coin will explode soon," or "Last chance to buy before it goes up." These messages are carefully crafted to create urgency. When people believe others are making money quickly, they feel pressure to join before the opportunity disappears. In many cases, investors end up buying at the peak, after the early promoters have already benefited. Another powerful tactic is social proof. Humans naturally trust ideas that appear popular. When a post has thousands of likes, comments, and shares, it creates the impression that the investment must be legitimate. Influencers and online personalities can amplify this effect. A single post from a well-known creator can bring massive attention to a stock or cryptocurrency, pushing more people to invest without doing proper research. Even seemingly small accounts can trigger viral trends when their content is shared widely. Online communities also play a major role. In forums, group chats, and financial communities, people often share positive predictions and success stories. Over time, these spaces can become echo chambers where everyone reinforces the same belief that an asset will continue rising. Negative opinions or cautionary advice are often ignored or downvoted, while optimistic posts dominate. This collective excitement can push people to act impulsively, buying into hype rather than making careful decisions. Another common manipulation technique is selective storytelling. Online content often highlights huge success stories but rarely shows the many people who lost money. Seeing constant examples of enormous profits can make risky investments seem normal, even though the majority of investors do not achieve these returns. The brain tends to focus on what could be, rather than what usually happens, which is exactly what these stories exploit. There are also pump and dump schemes. In these situations, a group buys an asset at a low price and then promotes it aggressively online. As excitement grows, new investors rush in, causing the price to spike. The early buyers then sell their holdings for profit, while late investors are left holding assets that quickly lose value. Even when not part of a formal scheme, hype-driven buying and selling can create similar patterns that manipulate emotions. Social media algorithms can unintentionally make this worse. Platforms reward content that generates strong reactions like excitement, fear, or curiosity. Bold predictions and dramatic investment claims often spread faster than careful financial advice. The more people interact with this content, the more the algorithm pushes it to larger audiences, creating waves of hype that feed on itself. Understanding these psychological tactics can give investors a major advantage. Recognizing emotional triggers like FOMO, hype, and herd behavior helps people make more rational decisions. Experienced investors focus on long-term fundamentals, research thoroughly, and question online narratives before acting. The internet has transformed financial markets. Information spreads instantly, communities grow larger than ever, and trends can emerge overnight. But markets are not driven only by numbers, they are driven by human psychology. The next time you see an investment trending online, remember that behind every viral post may be subtle but powerful forces shaping how people think and act. Recognizing those forces can help you stay rational and make better financial decisions. If you found this video insightful and want to uncover more hidden forces behind finance, technology, and investing, make sure to subscribe to the channel and stay tuned for our next deep dive.